Hi, this video will explain how to use position weights and cash weights in the portfolio. The two concepts are inextricably tied together because in order to activate the weighting system, one has to create the position weights variable, and I'll show you how that's done and how cash weights and other weights interact with that. So we're going to create a new screen called Playing with Weights, and this is going to be the very least exciting screen imaginable. All companies with a market cap over 10 billion. As we run this, we will see remarkably remarkably unexciting performance. Almost 99%, which slightly underperforms the S&P 500. When I create a new tab called Position Weights, this will now allow us to go ahead and change the weights. Notice here that we have a little sticky describing how it works. Now, if I go ahead and I put in, say, market cap, and I run this, we will get an S&P 500 weighted, market cap weighted screen, which does 11% better over that time. If I pick something weird like net income, then in theory I should get probably very similar results, but not quite. Apparently, we end up shorting a bunch of companies that are losing money, and that hurts us. So back to the more traditional, I'm going to go back to the default that the program has, which is 1, which means each stock gets 1 weight. And when I run this, we should get our 99%. Now, if I want to add cash weight to the portfolio, I simply do this. And now, at this point, I can put in whatever I want. If I put in a number, I'm not going to know how many positions I'm buying, and that's going to be undesirable. So I'm going to want to use the weight of the positive positions. And if I do that, I should end up with a portfolio that's 50% cash, 50% stocks. And you will see that it's relatively less exciting than it should be. If, for example, I have 90% cash rather than 50, or 91% cash rather than 50% cash, then it's really unexciting. I have 10 shares of cash and 1 share of stocks. And you'll notice the results are shockingly cash-like. If I go the other way and decide to take half the cash out of the portfolio, I'm now levered 2 to 1. This, you'll notice the downs are more pronounced, as you'll see by this down spike, and the ups are more pronounced on the upside. If your portfolio looks like this, even though you're not doing any cash weight, perhaps you're investing in very aggressive companies. Now, I can go too far with this. For example, something in me wants to try to see what happens if you do -1. And when you run this, you will find, actually, in this case, you don't get an answer. And the reason why not is because we're adding up all this stuff, removing all the cash, and we cause mass confusion. We literally have infinite leverage. That's not very productive. So we're going to put in something more reasonable, like we're going to remove, say, 2/3 or 3/4 of that. We're going to remove 2/3 of the money. So now at this point, you'll notice that the ups are very, very defined upwards. But notice we managed to lose more than 100% of our money. In the unlikely event that your broker let you get away with that and didn't make a margin call on your account, you could recover. But odds are you lost all your money right there, and you were hosed. So at your current skill level of stock picking, the most leverage you could handle is to have 40% of the account value in equity. And that gives you a jaw-dropping more than 50% loss. Drawdown of 88%, which is simply horrifying. So this portfolio is not smooth enough to be levered up like Morgan Stanley likes to do. So now I'm going to set the cash weight back to 0, and we're going to get our 99.64, and I'm going to add some other weights. How about a S&P 500 weight? If we can't beat the index, let's just join the index. Weight of positive positions times, say, 100. At this point, our line should look an awful lot like the S&P 500, and it does. Now, if I change the variable to be any other ETF, then we will see our portfolio magically transformed into 100 parts out of 101. small cap index fund and 1% whatever we think we're doing that's generating alpha. I could go into shorting and how to make that work, but I'm going to leave that for a separate video since I think this video has covered all the ground it needs to. Thank you very much for watching.